Welcome to the deep dive. This is the place where we take that fire hose of information you've given us, all the articles, the deep research, the financial models, and we filter out all the noise.
Right.
And we deliver the concentrated insights that you really need. We are your shortcut to being well-informed, diving deep into the structure and the mechanics of the world's most fascinating businesses.
And today, wow, we are tackling a behemoth.
We really are.
Perhaps the most admired company on the planet, Apple Inc.
Yeah.
Trading under the ticker AAPL. And our mission today is, well, it's highly specific and it runs directly into the core tension of value investing.
Okay.
We are going to analyze Apple, a business that, everyone acknowledges is high quality, but we're doing it through the rigorous lens of Warren Buffett's framework for late fiscal year 2025.
So the ultimate question here is the best company in the world actually worth buying at this price?
We're examining the structural strengths, what we're calling the fortress, against all these rising legal and competitive risks, which we've termed the regulatory siege. And the whole exercise, it really culminates in addressing that unavoidable problem of the price.
You've got it.
Yeah.
And we'll spend a good amount of time admiring this business because, frankly, it is a masterclass in durable competitive advantage. But we have to be dispassionate about the price the market is asking us to pay for that quality.
And our source material is solid for this one.
Oh, it's robust. We have comprehensive value analysis, strategic equity research covering the full FY 2025 results, and a really detailed breakdown of all the global antitrust developments hitting them in the EU, in Japan, and right here in the US.
Okay, before we unpack this giant, just a quick but necessary context setting.
Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice.
Conduct your own due diligence before making investment decisions. And if you want to listen to our full deep dive about this topic or access more advanced content, welcome to join Deep Value Club membership or subscribe to us on Apple and Spotify podcast channels. Deep Value Investing.
And as we track the temperature of the market based on some of the financial metrics we'll talk about today, metrics that define bubbles and crashes, remember you can search and download the iOS app Buffett Indicator right from the Apple App Store. It's a great tool to keep tabs on valuation sentiment as we move through this.
Okay, let's unpack this business. We have to start at the beginning. The qualitative assessment. These are the 4 gonna-go filters that Buffett uses to determine if a business is even worth looking at.
And if a company doesn't pass these 4 gates, the valuation exercise is, well, it's basically irrelevant.
It is. So does Apple qualify as a wonderful business?
The first filter is simple enough. Simplicity and predictability. We call this the elementary school test. Can we actually understand what the business does, and can we confidently predict its competitive position, say, 10 years from now?
Apple passes this with, perfect scores. The core business is remarkably easy to articulate.
It really is.
They design premium consumer electronics, the iPhone, the Mac, the iPad, and they sell these incredibly high-margin related services. It's the high-quality gadget plus the extraordinarily sticky ecosystem built around it.
And the genius, as the analysis points out, is the stability within an unstable industry.
Yes.
The business model has remained fundamentally unchanged for, well over a decade now. They are not chasing every single fad. They are the standard bearer for premium digital living.
And that's the crucial distinction for Gate 1. Buffett's rule is to shun businesses that could face obsolescence in 10 years.
Here.
Think back to a company like Kodak.
Oh, sure.
Their core business chemistry and film was just destroyed by digital photography. Technology was their enemy.
But Apple is the complete opposite of that.
Absolutely.
Yeah.
Apple is a beneficiary of technology change, not a victim of it. They constantly refresh their products with proprietary innovations like those custom M-series chips and the sophisticated sensor systems. Okay. The prediction isn't that the iPhone will look the same in 10 years.
Right.
The prediction is that Apple will still be selling the cutting-edge device and the cutting-edge services that define the premium end of the market. We can confidently make that prediction. Gate 1, clear pass.
Now for the foundation of the fortress, the durable competitive moat. The consensus here is unanimous. Apple doesn't just have a moat.
No.
It has a wide, self-reinforcing, and you could argue widening moat, protected by layers that just reinforce one another. So, what are the core pillars protecting this kingdom?
Okay, there are 3 real heavy hitters that provide genuine structural competitive advantage. The first one is basically non-replicable, intangible assets, specifically brand power.
Just the brand itself.
Apple's brand is world-class, valued by some estimates at, $263 billion? And that brand provides something absolutely priceless: substantial pricing power.
And we saw specific proof of that elasticity, or maybe inelasticity, back in 2022.
We did.
Apple hiked iPhone prices by about 5%, and customer demand, it barely even registered the change.
That's right. The analysis suggests Apple could probably sustain a 10% price increase across its products and retain the vast majority, maybe 95% of its high-end users. This is the definition of truly inelastic demand.
Yeah.
When your customers actively seek out your product, believing there is no adequate substitute, you have a wide moat. You can effectively print profits just by managing price tiers and ensuring your brand stays synonymous with premium quality and user experience.
So that's the first pillar. The second, and this is maybe the most powerful for long-term prediction, is the customer lock-in, or the switching costs.
Yeah.
We are talking about the Apple ecosystem iMessage, iCloud, the seamless handoff between the watch, the AirPods, the Mac. Breaking that interconnectivity is it's cognitively and financially painful.
And the demographic data here is critically important for the long view. The source notes a staggering statistic.
This one blew me away.
88% of U.S. teens own an iPhone. Just think of that. It's like a generational demographic bomb. These users are conditioned from a young age to live inside the Apple digital sphere. Trying to switch to a competitor means disrupting your social networks, the iMessage status, and losing all that seamless functionality.
And that inertia, it translates directly into the financial results.
Absolutely. Retention rates for iPhone users are consistently above 90%. Once Apple hooks a customer, the probability of keeping them is just extraordinarily high year after year. The moat not only keeps competitors out, it keeps customers locked in.
Okay, so pillar 3 is a classic, but I think it's often a misunderstood operational moat. Cost advantages through scale. Apple doesn't really compete on price, but they are a ruthlessly efficient financial machine because of their sheer size.
And this is really embodied by their operating model, the negative cash conversion cycle. It's financial wizardry. They effectively use supplier financing.
Right.
Just look at the balance sheet in FY 2025. They held about $70 billion in accounts payable. That's money owed to suppliers, but only $6 billion in inventory.
Can you just elaborate quickly on what that negative cycle means for the listener?
Certainly. It means Apple sells the product faster than it pays the manufacturer for the components. They collect cash from you, the customer. Almost instantly, they hold that cash, and they only pay their suppliers 60 or 90 days later.
So they're investing their suppliers' money.
They are essentially investing their suppliers' money, earning interest on the float. This structural working capital advantage is a powerful, self-funded operational moat that is extremely difficult for any smaller competitor to replicate.
And we see the proof of all these moats: the brand power, the lock-in, the scale in their margins. The gross margin is consistently high. And what's really impressive is that it's expanding. It's moved from that 38 to 40% range in the mid-2010s up to about 47% now.
That expansion, even with global inflationary pressures and supply chain volatility, is the ultimate confirmation of their resilience and pricing power.
Yeah.
It shows they are truly operating from a position of strength. So gate 2, a wide and widening pass.
Okay, moving to gate 3, management quality and capital allocation. Warren Buffett demands managers who act like owners, right? Prioritizing per share value over just building an empire.
And Apple management under Tim Cook scores exceptionally high here. Their track record of capital allocation is arguably among the top 3 in corporate history. It's famous that Buffett himself praised Cook, saying, nobody but Steve Jobs could have created Apple, but nobody but Tim could have run it this well.
That says a lot.
It says everything about Cook's mastery of operations and finance.
And the centerpiece of this owner mentality, which is so crucial for maximizing per share value, is the buyback machine. The scale is it's staggering. In the past 5 years alone, Apple has repurchased over $340 billion worth of its own shares.
Let's put that into perspective for you. This relentless buyback program has reduced the total share count from 16.4 billion back in 2014 down to about 14.8 billion in 2025. And they authorized another $90 billion program just this fiscal year.
Wow.
This continuous reduction in the equity base is the purest form of optimizing intrinsic value per share. It's a disciplined commitment to returning excess capital when internal opportunities just aren't sufficiently high returning.
But the critique you always hear about buybacks centers on whether management is sacrificing R&D or future growth for, these short-term stock bumps. Is Apple starving the business?
Not at all. Far from it. The sources confirm that management successfully balances these massive shareholder returns with substantial, very targeted internal investment. R&D in FY 2025 was $34.5 billion.
That's a huge number.
It's about 8% of sales. And that's where the cutting-edge M-series chips, the Vision headset technology, the massive AI push, and all that speculative future growth is being funded.
So we see rational capital allocation in action. They generate massive cash flow, they deploy the necessary capital for high-return R&D, and then they return the enormous excess in a very shareholder-friendly way.
It's highly disciplined, and it avoids that typical pitfall of CEOs who chase acquisitions purely for size, that whole empire-building mentality. Gate 3, exceptional pass.
Right, finally, gate 4. Industry structure and capital intensity. Is Apple stuck in some brutally competitive, capital-heavy industry that demands constant, massive reinvestment?
The answer is clearly no. While the broader tech world is competitive, Apple has executed this brilliant strategy of self-insulation.
Right.
It dominates the high-end segment, acting almost like a duopoly, iOS versus Android. But it maintains a premium positioning that shields it from the brutal commodity price wars that define the low end of the smartphone market.
And the capital intensity required to maintain this dominance is surprisingly low for a company that sells physical products. Why is that?
Because they brilliantly outsource all the heavy lifting. They design the products, but their suppliers handle the massive factory investments, the complex machinery, and the massive capex that manufacturing typically requires.
And that structural advantage, it shows up clearly in the numbers.
It does, yes. In FY 2025, capital expenditures, that's the money they had to sink into long-term assets, was only $12.7 billion. That's just 3% of revenue. And crucially, that capex figure is roughly equal to depreciation, which was $11.7 billion.
For our listeners, why is that relationship between capex and depreciation so important?
Well, when capex essentially equals depreciation, it's just a capital light profile. It means the company doesn't need to sink huge growing amounts of cash just to maintain its asset base.
Right, just to stand still.
Exactly. It suggests that most of the capex is routine maintenance, not necessary for radical growth. Apple can effectively grow without tying up massive amounts of cash in factories or machinery, which reinforces its cash generation capabilities.
So a clean sweep. Apple passes all 4 qualitative gates. It is, by every single measure, a wonderful business.
It is.
Now let's prove that the financial engine is just as robust as the reputation suggests. We move now from the qualitative filters to the hard data validation. This section is all about proving that the profits are real and backed by cash, starting with Buffett's true measure of profitability, owner earnings.
Owner earnings, or OE, is what we estimate the true cash profits of the business are, the cash the company can distribute to owners after maintaining its competitive position. We're using the trailing 12 months, the TTM, for FY 2025.
Let's break down the calculation slowly for clarity. We start with net income, which was a massive $112 billion.
Right. To that, we add back the non-cash expenses that look like losses but weren't actual cash outflows. Depreciation and amortization, that's $11.7 billion, and stock-based compensation, which is $12.9 billion.
Okay.
We then subtract what the business must spend to maintain its status quo.
And that includes maintenance capital expenditures, which we estimate is roughly equal to D&A at $11.7 billion, and we conservatively subtract another $10 billion for normalized working capital use, acknowledging that, normalizing year-over-year working capital changes can be complex.
When you net all that out, the normalized owner earnings are estimated at around $115 billion, but to be conservative for our valuation models, we carried forward a rounded figure of about $100 billion for the year.
And what's crucial is that this conservative OE estimate aligns almost perfectly with the reported free cash flow.
It does. It was $98.8 billion. For our listeners, that cash conversion rate is a critical metric, right? Because it confirms that the net income we see on paper is actually money in the bank, not just accounting magic.
Exactly. Operating cash flow in FY 2025 was $111.5 billion, nearly identical to the net income of $112 billion. That is a 99.5% cash conversion of earnings.
That's incredible.
Most companies show lower cash flow than net income because of aggressive accruals, meaning they recognize revenue before the customer has even paid the cash. Apple shows no such weakness. Their profits are real and they are liquid. There are absolutely no signs of earnings manipulation whatsoever.
Let's talk about operational efficiency. The return on assets, ROA, is an exceptionally high 31.2%. Most well-run, mature companies would struggle to break into the low double digits.
They're generating 31 cents of profit for every dollar of assets used.
And then we get to the elephant in the room, the triple-digit return on equity, ROE, of 152%.
That number is so high it just demands scrutiny. Is it dangerous leverage?
That's the question. The ROE relies heavily on a massive equity multiplier of 4.87, which typically signals high debt leverage.
So isn't that high leverage dangerous, or is there something structurally unique about Apple's debt profile that kind of shields them from the typical risks?
That's a fantastic question, and it is the key insight. We decompose the ROE using the DuPont analysis. ROE equals net margin times asset turnover times equity multiplier. Apple's high ROE is a function of its excellent net margin, 26.9%, amplified by that massive equity multiplier.
But the multiplier is not risky debt.
But this multiplier is not risky debt leverage.
It's the result of the buyback machine.
Precisely. The multiplier is artificially inflated because decades of massive share buybacks have intentionally shrunk the shareholder equity base. They're using debt, which is incredibly cheap for Apple, to fund the repurchase of equity. They aren't using debt to fund risky acquisitions or massive capital expenditures. They're just optimizing the capital structure for shareholders.
And this leads to the mind-boggling efficiency metric. Return on capital employed, ROCE.
When we strip out all that excess cash Apple holds to see the pure operational efficiency, the return on capital employed approaches a staggering 276%.
Wow.
For context, a truly successful, capital-heavy industrial giant, one that manages assets brilliantly, might hit a 15% ROCE. Apple is achieving returns nearly 18 times that benchmark. That number just underscores the pure financial power of their asset-light, outsourced manufacturing model. It's truly elite, unmatched performance.
It's proof of the operational genius behind the fortress.
No question.
The efficiency story continues with their ability to reinvest. Even at this massive scale, the numbers suggest they still have a long runway for high-return investment, partly because their reinvestment needs are so modest.
We can quantify that through the exceptional capital efficiency ratio. This metric looks at the cumulative owner earnings generated compared to the growth capital expenditures required to generate them. Over the last decade, Apple yielded a ratio of approximately 34.
34.
And remember, the benchmark for a capital-light, high-return business to be called exceptional is greater than 10.
So a ratio of 34 means that for every single dollar they reinvested to grow the business, they generated $34 in operating profits over time.
Yes.
That is the definition of a machine that compounds capital at extremely high rates.
And where does that reinvestment runway extend now? Well, first, market expansion into emerging markets, converting the remaining Android users to the ecosystem. Second, and more importantly, is that high-margin expansion in the services segment. Services growth is intrinsically high return because it requires R&D investment, not factory capex.
But the critical factor driving revenue growth isn't unit volume, which is, it's pretty mature. It's still their phenomenal pricing power.
Absolutely. Revenue growth has been driven primarily by rising average selling prices, ASPs. The iPhone ASP is steadily moving toward that $1,050 mark. They consistently raise the price floors without seeing any meaningful dip in demand.
It's the ultimate test of the moat. The customer just accepts those price hikes without meaningful defection. It suggests that their customer base has nearly inelastic demand for Apple products.
They will pay the premium.
They'll pay it because the product fulfills their need for quality, for status, and for that ecosystem integration.
Finally, we examine the foundation. Balance sheet integrity, which earns Apple the Fortress rating.
They are unique among megacap companies in being net cash positive, meaning they have more cash than total debt.
Correct. They ended FY 2025 with $132.4 billion in cash and marketable securities versus $99.3 billion in total debt. That leaves them with a $33.1 billion net cash surplus.
So in a global economic downturn, Apple has this massive strategic war chest and no immediate solvency concerns.
None. And the debt they do carry is minuscule relative to their cash generation. Their debt-to-EBIT ratio is tiny, around 0.75x. They could pay off all their debt in under 9 months of earnings. Interest coverage is estimated at well over 50 times, making debt risk essentially negligible.
Wow.
And their operational efficiency continues to impress on the working capital side. Inventory is minimal at $5.7 billion, representing just about 5 days of sales.
Which minimizes obsolescence risk in a fast-moving hardware environment.
It does. And fitting the classic value investor preference, goodwill is negligible. This means they generated their own $263 billion brand value internally, rather than buying it through overpriced, value-destroying acquisitions.
Okay, so to summarize the first two sections, Apple is a wonderful business with an expanding moat, exceptional capital allocation, perfect cash conversion, and an unrivaled balance sheet. The fortress is structurally flawless.
It is.
But even the best fortress can be breached by a determined, coordinated siege.
That's right.
Let's pivot to the primary risk facing Apple's $4 trillion valuation: the regulatory assault. And here's where the tension really ratchets up. The primary external risk isn't a new smartphone competitor. It is the global regulatory assault targeting the Apple tax and the walled garden structure that generates their highest margin revenue services.
The services segment is now a juggernaut. Revenue hit $109.16 billion in FY 2025, accounting for over 26% of total sales.
And the margins are the key. Because the gross margin for services is estimated at around 75%, this segment contributes nearly 40% of Apple's entire gross profit dollar generation.
Wow.
It's the highest quality, most recurring revenue stream they possess.
And that high-margin stream comes directly from the Apple tax, the 15 to 30% commission Apple takes on digital goods and in-app purchases. This mechanism originated from Steve Jobs' core principle of close control over the App Store, initially framed as ensuring quality and security.
But over 15 years, regulators argue that structure has evolved from a quality guarantee into a dual monopoly controlling both the mechanism of application distribution and the necessary payment processing.
Right.
This is what fostered the immense stickiness and those massive profits, and now it's being challenged globally.
And that fight begins with the European Union and the Digital Markets Act, or DMA. This law is specifically designed to curb the power of tech giants deemed gatekeepers, with market caps over 50 billion euros and large user bases.
And the requirements are surgically aimed at dismantling the fortress walls. The DMA demands three core changes. First, allowing third-party app stores. Second, allowing third-party payment channels.
And third, allowing web-based app downloads without going through the App Store at all.
Which is huge.
These requirements fundamentally dismantle Apple's ability to maintain a closed ecosystem. Apple was forced to comply and lower commissions down to 17% for general apps and 10% for small enterprises in the EU market. That already bites into the high-margin revenue structure.
But Apple's compliance was immediately met with controversy because they didn't just lower the fee. They introduced the highly contentious core technology fee, or CTF.
And the CTF charges developers 50 euro cents per user per year, but only after an app exceeds 1 million annual installs. The backlash here was instantaneous and severe because this fee is a prohibitive, non-profit contingent charge.
Let's illustrate the impact. A popular free app that generates no revenue but has 100 million annual installs, which is easily achievable for popular social media or utility tools, would suddenly face a 50 million euro CTF fee.
50 million.
Regardless of whether it generated a single euro of sales.
Correct. This fee is seen by developers as a de facto mechanism to maintain monopoly profits by crippling the free-to-use business model. It prevents developers from migrating to third-party stores, even with lower commissions, because the CTF threatens to bankrupt any application that succeeds on scale rather than transactional revenue.
And the EU has shown it's serious.
Yeah.
In April 2025, they imposed a massive 500 million euro fine on Apple for anti-scaring practices, ruling that Apple illegally prevented developers like Spotify from directing users to cheaper external payment options.
And that 500 million euro penalty is a strong indicator. It tells us that regulators are willing to impose massive financial pain to ensure compliance, and they view Apple's initial compliance moves like the CTF with intense suspicion.
And the regulatory siege is far from localized. We're seeing fronts open up all across Asia and, crucially, in Apple's home market, the US.
Japan is following the EU's playbook with its own mobile software competition law, which was enacted at the end of 2025. It also mandates the opening of third-party app stores and external payments.
What's fascinating is how Apple has tried to adapt its pricing strategy in Japan versus the EU.
Well, in Japan, Apple's concession is the lowest official rate globally, a 5% core technology fee for third-party stores or web apps. But, and this is key, this fee is levied against revenue, not installs.
Which makes it much less onerous.
Much less. Many developers are reportedly finding that 5% fee to be far more reasonable, as it fairly covers Apple's technical support and distribution infrastructure costs, unlike the controversial 50 euro cent per install fee in Europe.
And Japan means business. The penalty for non-compliance can be severe, up to 20 to 30% of their Japanese revenue, which is an enormous stick.
It is. This pressure is why Epic Games, the source notes, is finally able to bring Fortnite back to iOS in Japan using a third-party store, which demonstrates a true breach in the walls.
And meanwhile, the U.S. Department of Justice antitrust suit continues. That suit survived Apple's motion to dismiss back in June 2025 and alleges Apple maintains an illegal monopoly by suppressing competition in 5 key areas, including messaging, smartwatches, and super apps.
And the ongoing legal battle with Epic Games here in the U.S. continues to put pressure on the Apple tax. Federal judges ruled that Apple flagrantly violated earlier orders by continuing to charge a 27% commission on external payments.
So what happened with that?
The latest ruling in December 2025 upheld the violation finding, but will allow Apple to charge a reasonable commission, a rate based on its actual cost of processing, security, and distribution, not the historical 27% rate. This ruling pushes the fight into this protracted legal mediation to determine that precise, justifiable rate, effectively putting the entire App Store commission structure on trial.
So, okay, we have the EU establishing the precedent of dismantling the walled garden, Japan establishing a relatively fair pricing reference point with that 5% revenue-based fee, and the U.S. pushing for a cost-justified, reasonable commission. What is the ultimate strategic implication of this coordinated global siege?
It's the global domino effect. Every compliance move made in the EU or Japan sets a reference point for regulators everywhere else: Korea, the UK, Turkey, Brazil. Regulators talk to each other, and they look for the lowest common denominator in terms of concession.
So the worst-case scenario for Apple's valuation is a convergence.
Exactly. If a unified global compliance standard emerges, say, mandatory third-party access everywhere, combined with a 5 to 10% commission cap on all digital goods, the profitability of the $100 billion services segment will suffer a devastating blow.
Just walk us through that math.
If the gross margin on that $100 billion segment drops from 75% down to, say, 50% due to fee reductions in competition, Apple loses $25 billion in annual gross profit. That is a massive hit to the quality of their earnings.
And Apple's defense, according to the sources, involves what? Technical upgrades.
Right, boosting the security and compatibility arguments for iOS and business transformation, shifting revenue towards their proprietary subscriptions like Apple Music and iCloud, which are slightly harder for regulators to classify as monopoly price gouging.
But this regulatory siege really is the single biggest operational threat to Apple's financial model today.
Make no mistake, it threatens the core high-margin moat that justifies the company's current premium valuation.
So if that core cash cow is under siege, Apple has to be aggressively planting seeds for massive future growth to justify the market price.
They do.
Let's look at where they are pivoting their enormous R&D resources.
The overarching theme for FY 2025 is strategic recalibration. The era of explosive iPhone growth is over, replaced by a defensive necessity to find new multi-billion-dollar categories, primarily in AI and these speculative hardware bets.
The revenue snapshot confirms this shift. Total net sales reached $416 billion, a moderate 6.43% year-over-year increase. The iPhone still accounts for over half the business at $209 billion, but services is now over $109 billion, 26% of the total pie.
And the iPhone maturity is clear. Growth is moderate and driven almost entirely by average selling price, that ASP of $1050, not unit volume. The replacement cycle has lengthened significantly. 70% of buyers now hold their phones for 2 years or more.
It just shows that the device is technologically satiated for many users.
It is.
Interestingly, the Mac segment saw a strong recovery, growing over 12% to $33 billion. That's the M-series custom silicon transition story. The performance gains are compelling users who bought early M1 Macs to upgrade to M4 or M5 architecture.
And this leads to a crucial strategic insight, what the sources call the hand-me-down economy. Apple is implicitly encouraging device longevity, partly because a 4-year-old iPhone, now handed down to a secondary market user in an emerging economy, still generates that high-margin recurring services revenue.
So the moat continues to widen through services, even if the primary sales engine for new hardware slows down.
Precisely.
Now to the future. AI. Apple adopted a very distinct strategy with Apple Intelligence, AI, a hybrid, privacy-first approach that directly contrasts with its competitors.
They run lightweight models locally on the A and M series chips for instant utility and only offload the most complex queries to their custom private cloud compute, or PCC servers. The core selling point is privacy. Apple is telling the world, we can deliver sophisticated AI without harvesting your personal data to train our models.
Can you elaborate quickly on PCC? Is that essentially Apple proving they don't look at your data while processing the heavy AI lifting?
That's exactly the public relations message and the technical architecture. PCC uses secure proprietary hardware built by Apple to ensure that requests sent off device are processed without Apple or anyone else being able to access the underlying user data. It's a costly but essential move to maintain trust, particularly in privacy-conscious markets like the EU.
And initial adoption suggests success, at least for utility features. 88% of compatible iPhones adopted iOS 18. Features like notification summaries saw high engagement because they solved the pain point of information overload without requiring users to fundamentally change how they interact with the phone.
However, a functional feature gap remains between Apple and key competitors, particularly regarding real-time multimodal interaction.
The sources specifically contrast Apple's static visual intelligence with Google's approach.
Right. Take Google's Gemini Live. That offers real-time video stream analysis with a conversational overlay. You point your phone camera at a damaged bicycle part, and Gemini can tell you what the part is, where to buy a replacement, and give you step-by-step repair instructions all in real time. That level of proactive assistance is powerful.
And similarly, Samsung's Live Translate offers real-time, on-device translation in over 30 languages, eliminating language barriers instantly.
Another massive utility feature that drives adoption.
Yes.
The criticism of Apple Intelligence is that Siri, even with its latest Linwood LLM update, often punts complex, real-time queries to third parties like ChatGPT. And this creates platform risk because the user is conditioned to leave Apple's native environment to get complex answers. Apple is not yet the native real-time agent of the future, and the $275 valuation is pricing in the assumption that they will rapidly close this feature gap.
And this challenge is why their hardware roadmap is pivoting so sharply beyond the mature iPhone slab. The first big swing, the Vision Pro, has been, well, challenging.
Sales in 2025 are estimated to be under 1 million units, hampered significantly by the $3,500 price point and the 1.4-pound weight. It was a product designed for fidelity, maximum resolution, and immersion over form factor and comfort.
Right.
The early enthusiast market was strong, but the mass consumer market rejected the compromise on weight and price.
This forced the strategic pivot away from heavy, isolating AR. Apple has paused work on a cheaper headset, the rumored Vision Air, and is reallocating resources toward a more consumable form. Smart glasses, Project N50, aiming for late 2026 or 2027.
This is a recognition that the market prefers lightweight utility glasses that can provide quick, contextual AI feedback and notification support over heavy AR immersion. They are chasing the mass consumer market, recognizing that the primary utility of AR may be enhancing the experience away from the computer, not bringing the computer closer to your face.
And beyond AR, they are making a bold move into the home with Project J595, often described as the Pixar lamp home robot, following the cancellation of the Apple Car project.
This is a major speculative pivot, budgeted for high R&D spend. The robot is rumored to be a $1,000 tabletop smart home command center with an iPad-like display mounted on a robotic arm. The arm allows the screen to follow the user around a room, tracking their voice and providing constant interaction.
It's an attempt to create a more alive and proactive interface than the static competitors like the Echo Show or Nest Hub.
It is. And it's important to the valuation because the smart home market is massive, but fragmented and dominated by low-margin devices from Amazon and Google. Apple needs to invent a premium and differentiated category, a $1,000 smart home anchor that can hook customers into yet another high-margin service subscription layer. It's high risk, high reward.
And finally, the purely defensive hardware move. The foldable iPhone, Project V68, targeting a 2026 release with a clamshell design.
Yeah, this is not an innovation play, it's an insurance policy. It's meant to prevent high-end users who seek novelty and cutting-edge design from defecting to established foldable Android devices, particularly Samsung.
They can't afford to lose those highest-spending customers.
Exactly. Not even to niche competitors. These new hardware categories, smart glasses, robotics, and foldables, are the essential growth optionality the market is currently pricing in to the $275 stock price.
Which brings us to the final and most challenging section, connecting all this quality and inherent risk back to the current price tag.
So now we revisit the intrinsic value framework. Apple passed every single qualitative gate. They are an exceptional fortress-like business generating $100 billion in annual owner earnings. The question is, what is an exceptional business worth to a disciplined value investor? We use our normalized owner earnings of $100 billion and a standard 10% discount rate.
Okay, let's run the three scenarios to bracket the true intrinsic value, or IV per share.
Scenario A, the rock bottom baseline, no growth. If Apple earned $100 billion forever with 0% growth, a highly conservative assumption for a business of this quality discounted at 10%, the total value is $1 trillion. Dividing that by the 14.8 billion shares gives us an intrinsic value per share of approximately $67. That's the absolute worst-case floor value based on current earnings.
Scenario B, the base case, modest 3% GDP growth. Assuming Apple grows modestly at the rate of global GDP for perpetuity, which is a very reasonable expectation given its global reach and pricing power.
Using the Gordon growth formula, $100 billion growing at 3%, discounted at 10%, gives us approximately $1.47 trillion. That translates to an intrinsic value per share of roughly $100. This is our solid base expectation of value for a long-term owner.
And Scenario C, the optimistic case. Let's be generous and assume Apple can grow robustly, say at 6% annually for the next decade, fueled by services and new hardware, and then slow to 3% perpetual growth.
Using that two-stage discounted cash flow, or DCF, model, the total value comes out to about $1.84 trillion. That puts the intrinsic value per share at around $125.
Okay, so the realistic, disciplined range of intrinsic value based on conservative to highly optimistic assumptions is $67 to $125 per share.
And this is where the price problem becomes unavoidable. Apple's current market price is approximately $275 per share, implying a market capitalization above $4.07 trillion.
The gap is immense. The current price is more than double the most optimistic intrinsic value estimate we could responsibly derive. Why is the market willing to pay such an extreme premium?
Well, the market is no longer pricing Apple as a traditional hardware company. It is pricing it as the world's most successful subscription service distributor, whose hardware sales are merely the necessary upfront cost to acquire a perpetually recurring, high-margin customer. This perspective grants it a growth premium usually reserved for pure software platforms.
To truly understand the market's psychological expectation, we perform a reverse DCF. We ask, what sustained annual growth rate would Apple need to deliver for the next decade, flawlessly, to justify today's $4.07 trillion valuation?
The calculation is, well, it's staggering. To justify the $275 market price, the company would need to compound its owner earnings at approximately 15% annually for the next decade.
15%.
And 3% thereafter.
That is the price of corporate perfection and zero risk. We are talking about inventing the equivalent of 2 full-sized Amazons in 10 years, purely to justify today's price.
A 15% sustained growth rate would require Apple to roughly quadruple its profits in 10 years, reaching annual revenues near $1.5 to $2 trillion. That requires near-flawless execution in AI, the massive success of high-risk ventures like smart glasses and robotics, and the assumption that the $100 billion services segment will emerge from the global regulatory siege virtually unscathed.
And that staggering expectation forces us to apply the final critical step, the margin of safety.
Buffett demands a safety margin. For a quality business like Apple, we would apply a minimum 25% margin of safety, MOS, to even the optimistic IV of $125. That yields a desirable buy price of approximately $94.
Given that the stock is trading at $275, the conclusion, by disciplined value investing standards, is unavoidable.
Apple is a wonderful company, but it is demonstrably not at a wonderful price. The stock at $275 is significantly overvalued. It offers zero margin of safety and is trading at more than twice the most generous intrinsic value estimate.
So what's the final recommendation for the listener, whether they are a prospective or current owner?
The recommendation is hold, not buy. If you currently own Apple, you maintain your position due to the undeniable business quality. But for a new investor, you must wait for a better entry point, perhaps under $150, or ideally under the disciplined margin of safety threshold of $100, to ensure a high probability of acceptable forward returns. The price of perfection leaves absolutely no room for error or unexpected regulatory turbulence.
This has been a truly fascinating deep dive, meticulously showing us the tension between structural quality and market expectation. Apple passed every single quality test. The moat is widening, management is exceptional, and the cash flow engine is robust.
It did.
It failed only the final critical test. The price is simply too high for a new investor.
If you are an investor who currently holds Apple, there are key metrics you must monitor going forward to gauge if the moat is holding. First, watch the trend of services revenue growth. You want to see high single to low double digits. If services growth dips below 8%, it signals that the regulatory siege or general market maturity is having a greater than expected impact. Second, watch the gross margin. It must hold the 40% plus level, ideally staying near that current 47%. If the margin erodes, Apple is losing pricing power to either competitors or regulation.
And most critically, the global regulatory environment remains the biggest external risk. Any significant new penalty or unified global standard will hit profits directly.
Absolutely. The biggest long-term threat is the convergence of global regulation. The EU, Japan, and the US DOJ, leading to a unified global standard that significantly erodes the high-margin service commission structure. Any unified global fee structure settling definitively under 10% would be a major cause for reevaluation of the entire business model and its valuation.
Before we sign off, based on everything we discussed today, we want to leave you with one critical tension to mull over. The current $4+ trillion valuation relies entirely on the future success of unproven ventures like robotics and smart glasses and flawless AI execution.
Right.
While simultaneously assuming the $100 billion high-margin services moat will not be significantly breached by global regulators.
Which assumption? The flawless growth into entirely new markets, or the permanent integrity of the existing high-margin moat, is more likely to break first? That's what you should be thinking about as an owner of Apple stock today.
Thank you for joining us for the deep dive.
And remember, if you want to track total market temperature based on the financial metrics we discussed today, search and download the iOS app Buffett Indicator from the Apple App Store.
One final time, our necessary disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you want to listen to our full deep dive about this topic or access more advanced content, welcome to join Deep Value Club membership or subscribe to us on Apple and Spotify podcast channels. Deep Value Investing.
We'll see you next time on The Deep Dive.